morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those are all the top headlines that we're looking at this morning. So clearly there's a lot going on and we're going to talk about all of those individual news stories. But first up, let's take a look at what's happening across the markets. Asia is looking quite mixed to start off. You have Hang Seng on your screen, which is absolutely flat. Taiwan also, it's absolutely at the flat line, just around 2 points in the green there. So no big cues from there. The market which is doing the best this morning is the Japanese one. So the Nikkei is up around 0.8%. That one looking quite good. Straits is also seeing gains of around 0.7%. So those markets holding well in the green. What is in the red is the Korean market this morning. No big losses, but around 0.25% cut for the Korean markets, and the Chinese markets also seeing just a minor negative at the start of the trading session. So very, very mixed across the Asian markets. The SGX Nifty is also up on your screen, and it is indicating a little bit of a positive start for us. Around 40 points higher is what we have for us on the SGX Nifty. That's what's happening across the Asian markets. But let's talk about the US as well now. Wall Street ended yesterday's trading session lower. So the Dow Jones closed just below the flat line, while the S&P 500 was down 0.4%. The tech-heavy NASDAQ was, where we saw most of the pain come through. It was down over 1%. We now have CNBC's Bertha Coombs to get us a wrap of all of that action from Wall Street.
Moderate losses on Wall Street amid fears that China may return to tighter COVID restrictions as the country reported its first deaths from the virus since May. The Dow ended down about 0.1%, while the S&P closed with a loss of 0.4%, and the NASDAQ finished down over 1%. Disney was the standout of the day, up more than 6% during the session, helping to limit the Dow's drop. Disney, of course, one of the components in that index. Wall Street is happy that Robert Iger is coming back to run Walt Disney Company. He had stepped down as CEO almost 3 years ago now after a very successful run and had picked Bob Chapek to replace him. But it hasn't gone well for Chapek, who started during the pandemic, and a terrible earnings report last week apparently was the last straw for Disney's board. It surprised Chapek and everyone else by showing him the door last night and then rehiring Iger. That's the action from the U.S. market. Now back to you in Mumbai.
Bertha, thanks a lot for getting us all of that action from Wall Street. But let's also bring you some important opinion. This comes in from Cleveland Fed President Loretta Mester. She says that the Fed is nearing a slowdown in the pace of rate increases. But she did add that more positive data is needed on the inflation front to really ensure returning to price stability. Listen in.
At a point where we're going to enter a restrictive stance of policy. And at that point, I think it makes sense that we can slow down a bit the rate of pace, or the pace of increases. We're still going to have to raise the funds rate, but we're at a reasonable point now where we can then sort of now be very deliberate in setting monetary policy to get back to price stability, and be more judicious in balancing the risks so as to minimize the pain of that journey back to price stability. And so that's how I see the next phase of policy. So I don't think we're anywhere near to stopping, though, in terms of, you would phrase the question like slowing and then eventually pausing. We need to see inflation really on a sustainable downward path back to 2%. I do think we have to get into restrictive territory. My view is that we're just basically entering restrictive territory. And then we'll have to see, right? So we need to bring rates up further, I believe. And we said that in our last FOMC statement at our last meeting in early November, that we expected the Fed funds rate will have to move up further. But then we have to be judicious about sort of evaluating and letting the economy tell us, is inflation indeed moving down in a timely way, or do we have to even move rates higher, and where will that be? So we don't want to just be basing policy on lag data. We really want to be forward looking. And that's why having our Fed banks distributed across the country is really important.
All right, so on board for smaller rate hikes, but you do need to still see more positive data coming in on the inflation front. That is the word coming in from the Fed president of Cleveland. But with that, let's also bring you some important opinion on how the Fed is likely to act from here. This is from Jeremy Siegel, Jared Bernstein, as well as David Zervos.
It's taken way too long for the Fed to get it, and they haven't gotten it yet, that inflation is basically over, but they will. And I think they're going to get it maybe very late this year or early next year. And I think as soon as they get it, you're going to see a big increase in the equity prices. Housing index, as well as the federal index, both are expected to show another big decline. And as you know, my point has been housing is declined, but the way the government computes it, and it's a very important part of the index, it's so lagged that it'll continue to show increases.
Jay's message has been pretty steadfast. I don't think he's deviated. Even in the beginning of the year, he was trying to tell you, look, I'm going to go after this. Inflation got worse. He went after it harder. I think his credibility sits at a very, very high level, which is not what a lot of your guests say. A lot of people want to talk about Fed credibility being lost, but the dollar's strong, the curve's inverted, gold can't get out of its own way over the last couple of years. The break-even inflations and the long-dated inflation measures, like 5-year, those are all, range bound. So, this is mission accomplished on anchoring inflation expectations.
The Fed is obviously deeply committed to being the first and foremost inflation fighter. That's something President Biden has endorsed, and he has stayed way out of their knitting, just as I suggested I'm going to do too. And I don't think that tweaks or bips or bops in any variables are going to get them off track. I think obviously the key variables for them are inflation itself and to some extent the labor market and wage growth, which they're also watching very closely. Most of us tend to think that the interest rate, market interest rates are pretty endogenous to Fed actions at a time like this.
All right, that is some important global market opinion that we are bringing you. But with that, let's now talk about all of the cues that you should track as we get into a brand new trading session. We have our research team joining us with the trade setup. Ekta, Nigel and Vahishta all join me now to run you through what the trade setup looks like, as well as the individual stocks that you should keep on your radar. Guys, a very good morning to all of you. And Ekta, let me come across to you first. We did see a weak start, for the week, but tell us how it's looking this morning.
Well, yes, morning. The markets did close in the red for the third straight session yesterday. The Nifty ended below 18,200. The FII's net sold close to 1,600 crores and the DII's net bought around 1,260 odd crores. Now, in terms of the US markets, yes, it closed lower in what was quite a volatile session overnight. There is China, fears of China tightening its COVID-19 policy, which is likely to weigh on sentiment as it reported its first death since the month of May. Asia's mixed this morning. Brent crude is still hovering at around 2-month lows, so that continues to probably bode well for us. The outlook remains bearish on demand concerns as of now. SGX marginally higher as we speak. Now, in terms of a couple of macros, just keep this in mind. The Finance Ministry has told the parliamentary panel that the timeline for becoming a 5 trillion economy is postponed by 2 years, primarily because of the pandemic. The Finance Ministry has also started pre-budget consultations, so that's going to be something that we're going to start tracking. US Fed minutes on Wednesday, expiry on Thursday. Overall, it's a truncated week for the US markets as well because of the Thanksgiving holiday. And back home, watch for sector-specific interest, which continues in sectors such as metal as well as PSU banks.
All right, those are all of the cues that we should track for this trading session. Ekta, thanks a lot for that. But let's also talk about the individual names we should have on our radar. Vahishta has that entire list. Vahishta, good morning.
Good morning, Pavitra. First, let me start off with Nykaa, wherein a private equity firm called Lighthouse India will be selling its stake worth 320 crore rupees in the company. This is going to be a clean-out trade from the private equity firm. Moving on to JK Paper, which is acquiring a majority stake of 85% in Horizon Packs and Security Packs Packaging, and this is for a consideration of 578 crores. Moving on to New Delhi Television, where the Adani Group's open offer to acquire an additional 26% stake in the media firm from the market will start from today, and the offer will close on the 5th of December. The price band for offer has been fixed at 294 rupees per share, and earlier this month, SEBI had granted its approval to the proposed open offer. For Blue Star, Kotak AMC has increased its stake in the company to 5.05% from 4.979%, which was earlier. And the last is Keynes Technology India, which will be making its market debut today.
All right, Vaishta, thanks a lot for that entire list of stocks that we're going to watch out for. But let's also talk about the futures and options space and all of the cues from there. Nigel has that entire list. Nigel.
Well, morning. In terms of institutional flows, yesterday the institutions they turned net sellers. So, you look at both those two data points together. But also important to note that Ekta was just talking about the Thanksgiving truncated week out there. And the FI volumes are 40% lower on an average what we have seen in the rest of November itself. So FI participation really wasn't there in trade. What did the FIs do in the F&O market? Well, on the index futures, they unwound some long positions. On the index option side, they are buying calls as well as puts. Yesterday, they bought more puts than calls. But important to note that they're writing calls very aggressively as well. So in yesterday's trading session, they wrote close to around 50,000 call contracts. That was in the ratio of nearly around 3:1, telling you at higher levels, we're likely to see some bit of resistance or supply that's coming in there. Now, the PCR has cooled down to around 0.8. Remember, just a week or so ago, it was at around 1.2. So maybe at around 0.7 odd, it normally bases out. That's the lower end of the range. And that happened because yesterday, the 18,200 call, 18,300 call, 47 lakh shares added a piece. So between them, they added close to 95 lakh shares. Aggressive writing being seen out there. But the put writing has shifted lower from around that 18,300 put. It's moved to around 18,100 put. So there was some signs of writing out there. Putting those data points in, well, what are the levels you're looking at? The Nifty's range is broadly that 18,100 to around 18,400 odd. The support range comes in around 18,050 or thereabouts. And also keep in mind, the 20 DMA is in that vicinity of around 18,080. So let's see where we go from here. It's expiry week, so expect volatility as well to pick up. For the time being, the SGX Nifty suggesting a bit of a pullback. Back to you.
All right, Nigel, Vaishta, as well as Ekta, thanks a lot for joining us and taking us through all of the cues and stocks that we should watch out for in today's trading session. But with that, here's a quick programming note. To fully commit to the cause of bridging the gender parity gap at the workforce, CNBC-TV18 is all set to lead charge with a one-of-a-kind mega initiative. Future Female Forward, the Women's Collective presented by HSBC India. The initiative will be officially launched through an exclusive on-ground event on Friday, November 25th at the St. Regis in Mumbai in the presence of Shireen Pan, who's managing editor at CNBC TV18, Mr. Hitendra Dave of HSBC India, and several other women leaders of India Inc. Also in attendance will be some of the most influential voices from the business, entrepreneurship, and entertainment spaces. So don't forget to tune in to CNBC TV18 on Friday, the 25th of November, 5:30 p.m. onwards. All right, with that, it's time for our first short break on the show, but you don't go anywhere. When we come back, hey guys, welcome back. You're still tuned into Power Breakfast. Now, the Finance Ministry has told a parliamentary panel that India will now aim to become a $5 trillion economy by 2027. Now, the timeline for becoming a $5 trillion economy has been postponed by 2 years to 2027. This is because of the pandemic. However, inflation is expected to enter the 2 to 6% band by the fourth quarter. So, Parikshit is standing by the big wall to tell us more about this. Parikshit?
Top government officials have briefed the panel on India's roadmap for a $5 trillion economy and the problems that are there in the global economy right now. Sources say the government has said that the real GDP growth is expected to be between 6.5% to 7% in FY23, inflation to enter tolerance band of 2 to 6% by Q4 of FY23. Urban unemployment rate, which is at 7.6%, to fall further by end of fiscal, and private capex cycle could commence in FY24. Among the headwinds to India's growth path, pressure on currencies to depreciate against the dollar will persist into 2023. Loss of world output and trade could impact India's growth. Continued high crude prices will dilute domestic stimulus to growth, and food inflation could worsen due to climatic conditions. Now, the timeline for India becoming a $5 trillion economy has to be postponed because India has lost 2 years of growth because of the pandemic. The $5 trillion target can be achieved by 2026-27. For this, 6.5% annual growth rate would be needed, and inflation should be below 6% and US inflation closer to 3%. There are key reforms needed to cross $5 trillion target by 26-27. This is what the parliamentary panel has been told by government officials. Now, among the reforms, on the agriculture side, we would need land consolidation, facilitating crop diversification away from food grains into edible oils. On the power side, increasing user charges, improving DISCOM viability and reliability of affordable power for MSMEs. improve capacity of state governments to undertake local infrastructure spending, reduce compliance burden on MSME from state, local and union governments, greater focus on asset monetization and privatization, reduction of government debt stock and lower cost of capital. These are the recommendations of the Finance Ministry and Niti Aayog for the reforms that would be needed in order to cross the $5 trillion target by 26-27.
All right, Pariksha, thanks a lot for taking us through what the roadmap to this $5 trillion economy could look like. And the timeline for that is, of course, postponed by 2 years because of the pandemic and the kind of hit that we saw on account of that. But here's some corporate commentary as well. HUL's chairman and managing director, Sanjeev Mehta, says that volumes in rural India are seeing some stress and that demand may pick up once commodity prices soften. He's also uncertain on the future price hikes as they are closely linked to unpredictable commodity prices. So let's listen in to some of his comments.
There is a stress on volumes in rural India. But the good bit is that the headline growth is still there.
When can we expect a revival in the rural economy?
You know, there has to be a trigger. And one of the trigger will be when the commodity prices start softening.
Correct.
And when they start softening, I see no reason why the volumes won't come back. Difficult to speculate. It's very difficult to put your finger on, because they are dependent on many variables. The good bit is that palm oil prices had softened in a meaningful way, though after coming down, they've again gone up a bit, but they are still below their peak. So I think one of the trigger will be if the Ukraine crisis gets sorted, then we should definitely see a softening of commodity prices.
But then the sense I'm getting is that still a few more price hikes on the annual because there is...
No, price hike, I wouldn't like to say that there would be. It would really depend on commodity price. And remember something, there is no one-to-one equation between commodity price and the price of our goods.
Welcome back. You're still tuned into Power Breakfast. And as promised, let's talk about the commodity space now. Manisha Gupta joins us with an update. Manisha, there was quite a seesaw in the oil prices.
Oh, well, yesterday, if you were looking at that trade, it was surprising. There were statements, there were price moves coming in from all sides. And yes, at one point in time, we did see the crude oil prices decline by 5%, but the closing came nearly 0.5% on the higher side. There were statements and media reports that OPEC and allies were perhaps looking to increase oil production, but those statements were clearly counteracted by Saudi Arabia denying news of any potential output rise. Russia also said that they are not selling crude to nations participating in the price cap. It would be really interesting to see on what happens on 4th of December. That is when the OPEC and allies are meeting now to talk about the further production policy and review the demand too. So another 1 week and we are going to be looking at very choppy moves until then. The metal prices in the meanwhile have seen a sharp decline also. China has seen first death, COVID-related death, that is, in 6 months, and that really has dampened sentiment. We also are looking at weaker imports into China. The economic data has been on the weaker side as well. The Chinese industrial production slowed down in October. The housing sale numbers have been on the weaker side. So every data that has come out of China has been weak, and that has led to profit-taking across metals. So whether it is zinc, copper, aluminum, all of these metals are off their November highs.
All right, Manisha, thanks a lot for getting us all of that action from the commodity space. With that, we have to move on and bring you some somber news. An earthquake of 5.6% magnitude hit the main Indonesian island of Java on Monday, leaving at least 162 people dead and more than 300 injured. Officials fear that the death toll could be higher as many people are still trapped under the debris of damaged buildings. Even hospitals are overwhelmed with the rising number of patients. All right, disturbing visuals coming out of Indonesia there. Of course, we're tracking this and we'll keep bringing you updates on this through the day as well. But with that, we're going to wind down on this edition of Power Breakfast. The Asian markets are very mixed right now. The SGX Nifty around 40 points in the green. Thanks a lot for tuning in. Bazaar Morning Call is up next.